The yield trap illusion. You've seen the thumbnails. 12% yield, 15% yield. They look like a shortcut to retirement. But most of these are yield traps, funds that pay you with your own principal until the share price collapses. Today on Capital Compass, we're looking at a fund that has maintained a rock-solid 8% monthly distribution while actually preserving capital. We're going to look at the net asset value stability, the management team's track record through the 2022 crash, and why this specific sector is the safest place for monthly income right now. Welcome back to Capital Compass. Today, we're going beyond the surface level. Everyone talks about Apple, Tesla, or the S&P 500, but income investors have a different goal: cash flow without the roller coaster. We've identified a fund in the sector name, e.g., Business Development Company or Infrastructure CEF space that yields a reliable 8%. But a yield is just a number until you test it against the giants. Let's start by looking at why this sector is the hidden plumbing of the global economy. The asset class, private credit, and the senior lien secret. To understand why this fund is a fortress, we have to look at what's actually inside the vault. We're not talking about common shares of Coca-Cola or Microsoft. We're talking about private credit. When a mid-sized company, one making $50 million to $500 million in revenue, needs to expand, they don't always go to a big bank like J.P. Morgan. They go to institutional lenders. Our fund acts as that lender. But here is the Capital Compass secret: senior secured liens. In the capital stack, common stock is at the very bottom. If a company fails, the stockholders get zero. But our fund sits at the very top. We hold the senior secured position. This means the loan is backed by the company's hard assets, their buildings, their equipment, their intellectual property. We are the first to get paid. This first-out structure is why an 8% yield here is fundamentally safer than an 8% yield from a struggling retail stock. The stability: essential infrastructure versus tech volatility. Now, let's talk about the moat. Many high-yield funds chase tech or trendy sectors. Our safe 8% fund focuses on essential infrastructure. Think about toll roads, energy pipelines, and water treatment facilities. During a recession, what's the last thing people stop paying for? They might cancel Netflix or stop buying new iPhones, but they have to keep the lights on and the water running. These assets are illiquid. You can't just sell a bridge on an app, but that illiquidity is a benefit. It prevents the wild, emotional price swings we see in the S&P 500. While the world is panicking over a tech sell-off, these infrastructure assets continue to collect toll booth-style cash flow, which is then passed directly to you every single month. The mechanics: floating rates and the inflation hedge. Most income investors fear inflation because it eats the value of fixed bonds. But this fund has a built-in inflation shield. Most of these private loans are floating rate. When the Federal Reserve raises interest rates to fight inflation, the interest paid on these loans goes up. This means the fund actually makes more money when the economy is hot or when rates are rising. This is the exact opposite of a traditional bond fund like BND or TLT. For a Capital Compass portfolio, this is the perfect hedge. You're getting a raise just because the cost of living is going up. Pillar 1. The underlying engine. To understand this 8% safety, we have to talk about closed-end funds or CEFs. Unlike a standard ETF, a CEF has a fixed number of shares. This allows the managers to use modest leverage and covered call strategies to juice the yield without needing to sell their core holdings. We're looking specifically at fund ticker, which focuses on senior secured loans. These are top-of-the-capital stack investments. If a company goes bankrupt, these lenders get paid first. That is the foundation of our safety. Pillar 2. The discount to NAV alpha. The secret weapon for Capital Compass viewers is the discount to NAV. Because this fund is overlooked, it often trades for 5% to 10% less than the value of its actual holdings. You're essentially buying $1 of assets for 90 cents. This creates a margin of safety that protects you if the market dips. If the market stays flat, you collect your 8%. If the discount closes, you get a capital gains bonus on top of your monthly check. If this breakdown is helping you see the market differently, hit the subscribe and like button. It helps the algorithm find more income-focused investors. Pillar 3. Risk mitigation and stress testing. Let's look at the worst-case scenario. What happens if interest rates stay high? For this fund, that's actually a good thing. Since many of these loans are floating rate, the fund's income increases as rates rise. However, we must watch the default rate. We're going to analyze the fund's sector diversification. They aren't just in tech or real estate. They are spread across 20-plus industries. This diversification is why the dividend hasn't been cut in over years. The strategy. How to build your income machine. Don't just dump all your cash in at once. We recommend a laddered entry. By buying a set amount every month for 6 months, you average out the discount to NAV. We'll also look at how to set up your brokerage for automatic reinvestment, turning that 8% into a compounded 8.3% over time. Comment "Retire" below if you want my spreadsheet template for calculating your freedom date using this 8% yield. The comparison: our 8% fund versus JEPI, the covered call giant. If you like dividends, you've heard of JEPI. It's the $30 billion gorilla in the room. JEPI uses ELNs and covered calls on the S&P 500 to generate income. It's popular, but it has a weakness: it's capped on the upside. When the market rips higher, JEPI lags. Our safe 8% fund, however, doesn't rely on capping its upside. Because it invests in asset type, it captures organic growth plus the 8% yield. We're going to look at the total return over the last 3 years. You'll see that while JEPI provided great income, our overlooked fund actually outperformed in total wealth creation because of its underlying structure. The comparison: our 8% fund versus SCHD, the dividend growth standard. Then there's SCHD, the gold standard for dividend growth. SCHD is fantastic for someone with a 20-year horizon, but if you need income now, its 3.5% yield just doesn't cut it. To get the same monthly check from SCHD that you get from our 8% fund, you would need double the capital. Today, we're doing a yield-on-cost simulation. If you invest $100,000 today, we'll show you exactly how many years it takes for SCHD's growth to finally catch up to our 8% fund's immediate cash flow. Spoiler: it takes longer than most retirees have. The volatility tax. Why stability is profitable. Most investors ignore sequence of returns risk. If you're withdrawing money and the market drops 20%, you're selling shares at a loss. Our 8% fund acts as a shock absorber. Because the dividend is covered by interest income/rents/cash flow, the fund doesn't have to sell its winners to pay you. This is the volatility tax you avoid. We'll look at the 2022 bear market drawdown. While the Nasdaq fell 30%, this fund's income didn't budge. Architecting the portfolio. So, do you sell everything for this one fund? Absolutely not. For the Capital Compass community, we suggest the income barbell strategy. Put 50% in growth-focused funds like SCHD and 50% in this 8% king. This gives you the best of both worlds: rising dividends for the future and high-octane cash flow for today. This is how you build a retirement that isn't dependent on the whims of the stock market. Comment strategy if you want a follow-up video on how I'm specifically rebalancing my own portfolio for this 8% yield. The final verdict: this isn't a get-rich-quick scheme. It's a get-steady-rich strategy. For the Capital Compass community, this fund represents the safe middle ground: more yield than a bond, less risk than a growth stock. It's the engine that powers a monthly income lifestyle.